buyers are back, listings are still low, and so the real estate competition in Toronto is definitely back as well. But this time around, the market is more uneven, we would say, with a bigger demand pickup for end user type homes and generally homes that are all ready to go for investment properties. And so the best deals end up being homes that need work, and the reason is pretty simple. Most end users can't take on renovations even if they wanted to, because it could be tough to figure out where to live during the renovation period. And for those who are willing to figure all this out, they might still not want to do it or might not have the money to do so. And so if we can solve the financing for renovations bit, then this can open up a lot more opportunities for you as a real estate investor. Which brings us to a frequently asked question about financing for renovations. In this video, let's talk about how we typically like to do it, and then also introduce a special mortgage program from one of the big banks in Canada that not many investors actually know about, which could also help with this question. Without further ado, let's dive in. There are a couple of reasons why investors also would choose turnkey homes to invest in. The first one is that it could be easier to qualify for. When you buy an existing home that's not in very good condition, the banks would actually use market rents on that property to add to your income to qualify you. And if it's not in very good condition, the rents could be as low as $3,500 for the entire house. But if you buy a similar home in a much better condition, then the market rents might go up to $5,000, for example, and that bigger amount would be added to your qualifying income. So there's actually a lot more potential to qualify for a bigger mortgage if income qualifications is your concern. Now, the second part is that the amount of capital you need for a house that needs renovations is actually higher a lot of times because you can only get a mortgage on the current value of the home, which is basically your purchase price when you're buying it. And if you can't figure out how to get the money for renovations, then it's just out of the question to buy a property that needs work. So here's how investors do it. When you're first starting out, realistically, it would have to come out as cash. So saving up is definitely key. But as you start to grow your real estate portfolio, coming up with the money for renovations does actually get easier, and you also open up a lot more options. So some investors might refinance another investment property if there's extra equity there to pull out cash for the renovations. Typically, this offers the best rates, but you would have to be committed to a bigger mortgage for a fixed period of time. Now, another common way to do it is to get a HELOC, a home equity line of credit, on your current home if there's room there too. HELOC rates are higher, but the payments aren't actually as far off from regular mortgages because you don't have to pay for the principal pay down each month. It's also more flexible too. When you're not using it, you can pay it back at any time. So what happens is that this can be pretty useful for renovations. And then once you bring up the value of your newly renovated investment, you can refinance it and pull more cash out to pay off your HELOC and then lock into a bigger mortgage for the subject property. Now, here's where a concern might come in. Refinancing to pay off the HELOC only works when the market prices are stable or trending up. But it's true that there is a bigger chance in today's more volatile market that if market prices drop, the market value post-renovations might end up coming in lower than you expected. And so this could mean not being able to refinance as much and not being able to pay off your HELOC. Honestly, that is a very valid concern, which is why we wanted to share this A-lender mortgage program with you that ends up eliminating the short-term market volatility risk if this is something you're really concerned about. In a nutshell, this program guarantees your refinance amount right at the time of purchase. And another way to look at it is that you're getting qualified for your purchase amount and your refinance amount post-renovations all in one shot at the time of purchase. So what happens is that when you buy a property that needs work, you'll also need to send the bank a contractor quote for what you plan on doing, and the appraiser will take a look at everything before you buy. We want it to be clear that this is not a construction loan with the higher rates and multiple milestones. With this program, you're actually getting the best rates just like a normal mortgage. So once the appraiser looks at everything, they will give the bank a value as is and a value as completed, and the refinance amount would be the lesser of the value as completed or your purchase plus renovation costs. And then you'll get two separate fundings. The first funding will be just for the purchase, and so you would still need to use cash or a HELOC to pay for your renovations up front. But after renovations, what they'll do is they'll inspect to make sure everything is done properly. And once it's okayed by the bank, you'll get the rest of your funding. So from a risk standpoint, this is great if you're looking to get rid of that short-term refinancing volatility risk, but there are also a few things to keep in mind as well. First of all, because you'll need to get contractor quotes before they approve this mortgage, you'll want to have your contractor contacts lined up and ready to give you a quote on demand. And if this is the only option you're considering, then you would have to go into a purchase with a mortgage condition, and this could affect your competitive edge if there are other buyers who have better offers. The other thing to keep in mind is that the maximum value that the bank might approve you for is the purchase plus renovations amount. So if the market ends up heating up a lot more, then you end up still having to do another refi to top up that amount. And then there's also the fact that you would have to do what you said you did. So if your final improvements don't match the initial scope of work that you submitted, then you might actually end up needing to pay for the cost difference. But all in all, we do think that this is a great program and a great mortgage alternative, and it can also help you if you need a little bit of an extra hand with income qualifications too. I mentioned earlier that banks use existing market rents to qualify you, but in this case, future rents are used, and so you could potentially end up buying something that you might not have been able to qualify for using a normal mortgage. Hopefully this video was helpful for you, and if you want to learn more about this program, just reach out to us and we'd be happy to share the details. We're also around to help you learn more about these types of investment opportunities with major renovations and give you advice on how to best structure your finances. So just contact us if you want to book a time to chat privately. And if you found this video useful, make sure to give us some love by liking this video and subscribing to our channel. We dive into a bunch of topics related to real estate investing in Toronto, including market trends, housing policy, interest rates, and investment tactics. We really want to make investing in real estate simpler for you, which is why we provide a comprehensive range of services to support you from planning and analysis to sales, renovations, leasing, and property management. So just check us out on our website, or you can also find us on social media too. Thanks so much for watching, and we'll see you in the next video. Bye!